I'm about to tell you something that's going to surprise a lot of people. After sitting on over $300 billion in cash for the past 2 years, after being criticized for being too cautious, after watching countless investors question whether I've lost my touch, I'm finally deploying capital aggressively, and I'm doing it before January of 2026. Not February, not next quarter, before January. There's a specific reason for this timing that I'm going to explain, and there are 3 specific stocks that I'm moving into that represent the best opportunities I've seen in years. Today, I'm going to tell you exactly what these 3 stocks are, why I'm buying them, and why the window for getting in at these prices closes in January. This isn't hype. This isn't marketing. This is the result of months of analysis, decades of experience, and a unique set of circumstances that are aligning right now to create once-in-a-decade opportunities. Let me start by explaining why I've been holding so much cash. People have been criticizing Berkshire Hathaway for years about our cash position. They say we're being too conservative. They say we're missing opportunities. They say the world has changed and we don't understand it anymore. But here's what they don't understand. I've been holding cash because I couldn't find investments that met my criteria. Stock prices were too high. Valuations were stretched. The risk reward wasn't attractive. So I waited and waited and waited. People thought I was crazy. But I've learned over 8 decades that patience is one of the most important qualities in investing. You don't need to swing at every pitch. You can wait for the fat pitches, the ones right in your sweet spot. And when they come, you swing hard. That's what I'm doing now. The market has given me 3 fat pitches, 3 stocks that meet all my criteria. High quality businesses with durable competitive advantages, trading at prices that are significantly below intrinsic value, with catalysts that will drive value realization over the next 12 to 18 months. And the timing matters because of specific events happening in January that will impact these opportunities. Before I tell you what these 3 stocks are, let me take you back to a moment that shaped how I think about timing and investing. It was December of 1973. The market had been declining for over a year. The oil crisis was hitting the economy. Inflation was accelerating. Recession was starting. And stock prices had fallen dramatically. Everyone was bearish. Everyone was scared. But I was excited because I was seeing opportunities everywhere. Great. Businesses trading at absurd prices. I started buying aggressively in late 73 and into 74. And those investments made at the depths of pessimism generated extraordinary returns over the following decade. The lesson wasn't just that buying during fear pays off. The lesson was about recognizing when all the pieces are in place. When you have quality businesses, attractive valuations, and a catalyst for change. When those 3 things align, you need to act. And that's exactly what I'm seeing now with these 3 stocks. Let me tell you about the first stock. This is a large regional bank that I believe represents the single best investment opportunity in the financial sector right now. I'm going to be specific here because I want you to understand exactly what I'm seeing. This bank, let's call it Bank A, is based in the Southeast. They have about $120 billion in assets. They operate in some of the fastest growing markets in America. Florida, Texas, Georgia, the Carolinas. These are states where population is growing, businesses are relocating, and economic activity is expanding. This creates natural demand for banking services. Now, why is this bank so attractive? Let me walk you through the characteristics. First, the deposit base. This is the most important thing to understand about any bank. Where do their deposits come from? Are they stable? Will they stay even when interest rates change or when there's economic stress? This bank has one of the best deposit franchises I've seen. About 75% of their deposits are under the FDIC insurance limit. These are small business checking accounts and consumer checking accounts. People who need these accounts to operate their businesses and their lives. These deposits are incredibly sticky. During the regional banking crisis of 2023, when other banks saw deposit flight, this bank's deposits barely moved. Customers stayed because they trust the bank and because moving would be a hassle. This stability is invaluable. Second, the loan portfolio. This bank has been very disciplined about underwriting. Their loan book is diversified across commercial and industrial loans, residential mortgages, commercial real estate, and consumer loans. No single category is more than 35% of the total. And within commercial real estate, they've been very cautious about office buildings. They saw the remote work trend early and pulled back on office lending. Their commercial real estate book is mostly retail, industrial, and multifamily. Properties in growing markets, these are much safer than office buildings in declining cities. The loan quality is excellent. Their non-performing loan ratio is under 1%. Their net charge-offs are minimal. This tells me that management is conservative and disciplined. They're not chasing growth by making risky loans. Third, the balance sheet strength. This bank has a fortress balance sheet. Common equity Tier 1 capital of 14%. That's well above regulatory requirements. They have substantial liquidity. Their bond portfolio has unrealized losses like most banks, but those losses are manageable relative to their capital. And the duration is moderate, so as rates stabilize or decline, those losses will reverse. Most importantly, they're not forced sellers. They can hold bonds to maturity and collect the full par value. Fourth, the management team. I've studied their track record over the past 2 decades. They've navigated multiple economic cycles successfully. During the financial crisis of 2008, while many banks failed, they survived without government assistance. They maintained profitability. They emerged stronger. This tells me that management knows how to operate prudently through difficult times. Now, here's what makes this so compelling. This bank is currently trading at about 8.5 times earnings. 8.5 times. For a high quality bank with a fortress balance sheet, growing markets, excellent deposit franchise, and conservative management, that's absurdly cheap. Before the regional banking crisis, comparable banks traded at 13 to 15 times earnings. Even in a normalized environment, this bank should trade at 12 to 14 times earnings. At 12 times earnings, the stock would be worth about 40% more than the current price. At 14 times, it would be worth 60% more. Plus, they're paying a dividend of about 4%. So you're collecting income while you wait for the valuation to normalize. Why is it so cheap? Fear, pure fear. Investors are still scared of regional banks. Because of what happened in 2023, they assume all regional banks are risky. They don't differentiate between banks with good balance sheets and banks with problems. This indiscriminate fear has created an opportunity. Now, why am I moving into this before January? Because several things are happening that will change the perception of regional banks. First, the Federal Reserve is likely to cut interest rates again in December and probably in early 2026. Lower rates will improve bank profitability. They'll be able to pay less on deposits while loan yields remain relatively stable. This will expand net interest margins and boost earnings. Second, we're getting further away from the banking crisis of 2023. Time heals wounds. As memories of that crisis fade, investors will start to differentiate between good banks and bad banks. They'll recognize that the high-quality banks like this one were never at risk. They'll start buying again. Third, and this is the key catalyst, the major banks will be reporting fourth quarter earnings in mid-January. Those reports will likely show that the banking sector is stable and profitable. Loan quality is holding up. Deposits are stable. Net interest margins are stabilizing or improving. When investors see this data, confidence will return. Money will flow back into bank stocks. By the time those earnings are reported, the easy money will have been made. The stocks will have already moved higher. That's why I'm buying now in December before the January earnings releases. I'm positioning ahead of the catalyst. Fourth, there's likely to be regulatory clarity coming in early 2026 about bank capital requirements. The regulators have been working on new rules. Once those rules are finalized and banks know what's expected, it removes a major source of uncertainty. This will be positive for bank stocks. All of these factors, rate cuts, fading memories of the crisis, positive earnings reports, regulatory clarity, they're all coming together in the January to March timeframe. That's why the window is now. If you wait until February or March to buy, you'll be paying significantly higher prices. The opportunity is to buy now while fear still dominates and position yourself before these catalysts play out. Now, let me tell you about the second stock. This is an integrated energy company that I believe is the best value in the entire energy sector. Let's call it Energy Company B. This is one of the major oil companies. They produce about 3 million barrels of oil equivalent per day. They have upstream production operations in North America, South America, Europe, Africa, and Asia. They also have downstream refining and chemical operations. This integration provides stability because when upstream margins are weak, downstream margins often strengthen, and vice versa. What makes this company special? Several things. First, the asset quality. This company has some of the lowest cost production in the industry. Their average production cost is about $32 per barrel all in. That includes finding costs, development costs, production costs, and corporate overhead. At current oil prices around $80 per barrel, they're earning almost $50 per barrel on their production. That's exceptional profitability. And because their costs are so low, they remain profitable even if oil prices decline. They can make money at $45 to $50 oil. This gives them enormous resilience. Second, the reserve base. They have proven reserves that represent about 15 years of production at current rates. And they're continuing to find and develop new reserves to replace what they produce. Their reserve replacement ratio has been over 100% for the past 5 years. This means they're finding more oil than they're producing. The resource base is not depleting, it's growing. Third, the financial strength. This company has a very strong balance sheet. Their debt is manageable. Their interest coverage is excellent. They generate massive amounts of free cash flow. Over the past 12 months, they've generated about $35 billion in free cash flow. What are they doing with that cash? Paying a dividend of about $15 billion, buying back stock worth about $15 billion, and reducing debt or building cash with about $5 billion. The dividend yield is currently about 5.2%. The buyback yield is about 5%. Combined, they're returning over 10% of their market cap to shareholders annually. 10%. And they're doing this while maintaining their asset base, investing in new projects, and strengthening the balance sheet. Fourth, the valuation. This company is trading at about 6 times earnings. 6 times. For a business that's essential to the global economy, that has low cost, long life reserves, that generates massive free cash flow, that returns huge amounts of cash to shareholders. Before the ESG movement and energy transition fears, comparable energy companies traded at 10 to 12 times earnings. Even today, in a world that's supposedly moving away from fossil fuels, this company should trade at 8 to 10 times earnings given its cash generation and capital returns. At 8 times earnings, the stock would be worth 30% more than today. At 10 times earnings, it would be worth 60% more. Plus you're collecting over 5% in dividends. And the company is buying back 5% of shares annually. In just 5 years, if they continue this buyback pace, they'll retire 25% of shares outstanding. That means earnings per share will be 33% higher. Even if total company earnings stay flat, the stock price will have to adjust to reflect that. This is the magic of buybacks at low valuations. Why is it so cheap? The same fears I've discussed before. Investors think oil demand is going to collapse. They think electric vehicles and renewable energy will destroy the oil industry. They think these are dinosaur companies with no future. But the data doesn't support this narrative. Oil demand is still growing globally. It grew last year. It's growing this year. And it's projected to keep growing through at least 2030. Yes, eventually, decades from now, oil demand will peak and decline. But that's a long time away. In the meantime, the world needs enormous amounts of oil for transportation, plastics, chemicals, and industrial processes. And here's the critical point. The oil industry has been underinvesting in new production for years because of ESG pressure, because of investor hostility, because of government policies. Oil companies have cut back dramatically on exploration and development spending. This means that as existing wells decline, naturally, there isn't enough new production coming online to replace them. Supply is going to tighten. And when supply tightens while demand is still growing, prices go up. I believe oil prices will remain in the $75 to $90 range for the foreseeable future, maybe higher if supply constraints become severe. At these prices, this company will continue generating massive free cash flows and returning huge amounts to shareholders. Now, why am I moving into this stock before January? Because several catalysts are coming that will benefit energy stocks. First, OPEC is meeting in early December to decide on production levels for 2026. They're likely to maintain or even reduce production to support prices. This will be positive for oil prices and energy stocks. Second, we're entering the winter heating season. Demand for oil and natural gas typically increases in winter. If we have a cold winter, which some forecasters are predicting, energy demand could be strong. This supports prices. Third, the new administration taking office in January is likely to be more favorable to the energy industry than the previous administration. There may be policy changes that benefit oil and gas companies, reduced regulatory burdens, faster permitting for new projects, more access to federal lands for drilling. These policy changes would be positive for energy company profitability and investor sentiment. Fourth, major energy companies will be reporting fourth quarter earnings in late January and early February. Those earnings are likely to be strong because oil prices have been solid and refining margins have been good. Strong earnings reports will attract investor attention back to the sector. All of these catalysts, OPEC meeting, winter demand, new administration, policies, strong earnings reports, they're concentrated in the December to February timeframe. That's why I'm buying now. I want to be positioned before these catalysts play out and drive the stocks higher. By March, energy stocks could be trading 15 to 20% higher than today, maybe more if oil prices spike. The opportunity is to buy now while the sector is still unloved and undervalued. Now let me tell you about the third stock. This is a pharmaceutical company that represents the best value in healthcare. Let's call Pharma Company C. This is a large cap pharmaceutical company with a market cap of about $200 billion. They have a diversified portfolio of drugs across multiple therapeutic areas: oncology, immunology, cardiovascular, diabetes. This diversification is important because it means they're not dependent on any single drug or disease area. What makes this company attractive? First, the current drug portfolio. They have 8 blockbuster drugs that each generate over $2 billion in annual revenue. Combined, these 8 drugs generate about $25 billion in revenue and are highly profitable. Most of these drugs have patent protection for at least 5 more years. Some have protection for 10 years or more. This provides a solid base of predictable high margin revenue. Second, the pipeline. This is crucial for pharmaceutical companies. You need new drugs coming to market to replace older drugs that go off patent. This company has one of the strongest pipelines in the industry. They have 5 drugs in late-stage phase 3 clinical trials. These are drugs that have shown positive results in earlier trials and are now being tested in large populations to confirm safety and efficacy. The probability of approval for phase 3 drugs is about 65 to 70% on average. If 3 or 4 of these 5 drugs are approved and launched successfully, they could add $10 to $15 billion in annual revenue within 5 years. That's substantial growth on top of the existing business. Third, the financial profile. This company is a cash machine. They have operating margins of about 30%, very high. They generate about $20 billion in free cash flow annually. They pay a dividend of about $8 billion. They invest about $8 billion in research and development to keep the pipeline full, and they buy back about $4 billion in stock. The dividend yield is currently 3.2%, not huge, but solid and growing. They've increased the dividend every year for 25 consecutive years. That's a sign of a stable cash generative business. Fourth, the valuation. This company is trading at about 12 times earnings. 12 times for a pharmaceutical company with a strong portfolio, robust pipeline, high margins, and substantial free cash flow generation. Before concerns about drug pricing became a major political issue, comparable pharmaceutical companies traded at 16 to 18 times earnings. Even today, with all the political headwinds, this company should trade at 14 to 16 times earnings. At 14 times, the stock would be worth 15 to 20% more than today. At 16 times, it would be worth 30 to 35% more. Why so cheap? Political fear about drug pricing. There's been years of talk about government price controls, about Medicare negotiating drug prices, about importing drugs from Canada. All of this has scared investors away from pharmaceutical stocks. They worry that profitability will be destroyed by price controls. But here's what's actually happened. Yes, there have been some modest reforms. Medicare can now negotiate prices on a small number of drugs. But the impact has been much less severe than investors feared. Pharmaceutical companies are still highly profitable. Drug pricing is still adequate to support innovation. The worst case scenarios that investors feared have not materialized, and they're unlikely to materialize because the pharmaceutical industry serves an important function. We need new drugs for cancer, Alzheimer's, heart disease, and many other conditions. If we destroy the profitability of drug development, we'll get fewer new drugs. Policymakers understand this. So while there's pressure to moderate drug prices, there won't be draconian controls that eliminate industry profitability. The market has overreacted to the political risk. Now, why am I moving into this stock before January? Because several catalysts are coming. First, this company is expected to receive FDA approval for one of their phase 3 drugs in late December, early January. This is a major new drug for a large patient population. If approved, it could generate $3 to $4 billion in annual revenue at peak. The market knows this approval is coming, but hasn't fully priced it in yet. When the approval is announced, the stock will likely jump. Second, the company will be reporting fourth quarter earnings in late January. Those earnings are expected to be strong. They're likely to raise guidance for 2026 based on the new drug approval and strong performance of existing drugs. Positive earnings and raised guidance will attract investor attention. Third, there's growing recognition that the political risk around drug pricing has been overblown. As we get further from the heated political rhetoric of election years, investors are realizing that pharmaceutical companies are still good businesses with good economics. Sentiment is improving. Money is starting to flow back into the sector. Fourth, the demographic tailwinds for pharmaceuticals remain incredibly strong. The population is aging. Older people use more prescription drugs. The middle class is expanding in developing countries. As people get wealthier, they spend more on healthcare. These trends support long-term demand growth for pharmaceuticals. All of these factors, the drug approval, strong earnings, improving sentiment, demographic tailwinds, they're coming together in the January to March timeframe. That's why I'm buying now. I want to be positioned before the catalyst of the drug approval and earnings report. By February or March, this stock could easily be trading 10 to 15% higher. The opportunity is to buy now before the market fully prices in these positive developments. Now, let me talk about how I'm sizing these positions and how you should think about portfolio construction with these 3 stocks. I'm not putting all my eggs in one basket. I'm diversifying across all 3. My target allocation is about 35% to the bank, 35% to the energy company, and 30% to the pharmaceutical company. Why this allocation? The bank and energy company have the most upside potential. They're trading at the cheapest valuations, 6 to 8.5 times earnings. The potential re-rating is substantial. They could easily trade at 12 to 14 times earnings once fear subsides. That's 50 to 70% upside. Plus, you're collecting 4 to 5% dividends. The pharmaceutical company has less upside potential, maybe 25 to 35% as it re-rates from 12 times earnings to 15 or 16 times. But it's also less risky. It's a more stable business. The cash flows are more predictable. It provides ballast to the portfolio. So I'm allocating 35% each to the higher risk, higher reward bank and energy positions, and 30% to the lower risk, solid return pharmaceutical position. This gives me a balanced portfolio with good diversification across sectors. If you're investing in these 3 stocks, you should consider a similar allocation based on your risk tolerance. If you're more conservative, maybe reduce the bank and energy exposure to 30% each and increase pharma to 40%. If you're more aggressive and younger, maybe go 40% bank, 40% energy, 20% pharma. The key is to have significant exposure to all 3, so you benefit from whichever ones work out best. Now let me address some objections and concerns I anticipate. First objection is, what if the economy goes into recession? Won't these stocks get hit? Yes, if we have a recession, these stocks will probably decline in the short term. But that doesn't change the long-term value. The bank I'm buying has a fortress balance sheet and conservative underwriting. They'll survive a recession fine. They might have some loan losses, but nothing that threatens the business. The energy company is profitable even at low oil prices. And demand for oil doesn't disappear in recessions. It slows, but the company will keep generating cash. The pharmaceutical company is recession resistant. People still need medications regardless of the economy. So yes, short-term volatility is possible, but the long-term value proposition remains intact. And remember, I'm buying these at very cheap valuations, at 8.5 times earnings for the bank and 6 times for the energy company. A lot of bad news is already priced in. There's not much downside unless something truly catastrophic happens. Second objection is, what if interest rates don't come down as expected? What if the Fed keeps rates high? This would be a headwind for the bank in the near term. Higher rates mean they have to pay more on deposits, but it's not catastrophic. The bank is profitable even at current rates, and eventually rates will come down. The Fed can't keep rates at 5% forever when inflation is at 2%. Real rates are too high. They'll come down. Eventually, maybe just slower than expected for the energy company and pharmaceutical company, interest rates don't matter much. Their business models aren't interest rate sensitive. Third objection is, what if oil prices collapse? This is always a risk with energy stocks, but I think the probability is low. Global oil demand is still growing. Supply is constrained because of underinvestment. OPEC is managing production to support prices. And even if oil prices do decline to $60 or $65, this company is still profitable at those levels. They might generate less free cash flow, but they're not going to lose money. And remember, they're buying back stock aggressively at 6 times earnings. Even if earnings decline somewhat, the buybacks are creating value because they're retiring shares at very cheap prices. Fourth objection is, what if the drug approval for the pharmaceutical company gets delayed or denied? This is a risk with any drug in development. Clinical trials don't always work out, but this drug has already shown positive results in phase 2 and interim. Phase 3 results, the probability of approval is high, probably 70 to 80%. And even if this particular drug doesn't get approved, the company has other drugs in the pipeline. The investment thesis doesn't depend on any single drug. It's based on the overall portfolio and pipeline. Fifth objection is, why should I trust your timing? What if you're early? I might be early. I often am. I might buy in December, and these stocks might drift lower in January before moving higher in February or March. That's fine. I'm not trying to time the exact bottom. I'm buying when valuations are attractive and catalysts are on the horizon. If the stocks go lower before going higher, that just gives me an opportunity to buy more at even better prices. The key is that I'm buying quality businesses at reasonable to cheap valuations over a 3 to 5 year period. I'm confident these investments will generate strong returns, regardless of short-term volatility. Now let me talk about the broader context that makes this the right time to be buying stocks. We're in a unique moment where several factors are aligning. First, inflation has come down dramatically. We peaked at 9% inflation in 2022. Now we're back to 2%, right at the Fed's target. This is important because it means the Fed can cut interest rates without worrying about reigniting inflation. Lower rates are positive for stock valuations and economic growth. Second, the economy has remained resilient despite aggressive rate hikes. Everyone predicted recession. It hasn't happened. The labor market is strong. Consumer spending is solid. Corporate profits are growing. This resilience suggests that when rates do come down, we could see accelerating growth. Third, corporate profit margins have held up remarkably well despite higher labor costs and other headwinds. This demonstrates pricing power and operating leverage. Companies are managing well in a challenging environment. Fourth, stock valuations, while not cheap overall, are reasonable in certain sectors. The overall market might be fairly valued or slightly expensive. But there are pockets of value. Banks, energy, and healthcare are all trading at below average valuations relative to their histories. This creates opportunity. Fifth, investor sentiment has become more balanced. We're not in euphoria. territory where everyone is bullish. We're also not in panic territory. We're somewhere in the middle. This is actually ideal for finding opportunities because there's still some skepticism and fear creating pockets of undervaluation. All of these factors create a favorable environment for stock returns over the next year or two. And the three stocks I've identified are positioned to benefit from this environment. Now, let me share some lessons from my 8 decades of investing that apply to this situation. First lesson is about the importance of acting when you have conviction. I've been sitting on cash for 2 years waiting for opportunities. People criticize me for this, but I knew that eventually opportunities would appear. And now they have. When you finally see investments that meet your criteria, you need to act decisively. Don't wait for perfect information. Don't wait for confirmation. If the valuation is attractive and the business is quality, buy. I've made more money by acting on high conviction ideas than by being overly cautious. Second lesson is about the importance of diversification even when you have conviction. Yes, I have high conviction about these 3 stocks, but I'm not putting everything into one. I'm spreading across 3 different sectors. This protects me if I'm wrong about any individual stock. Even the best investors are wrong sometimes. Diversification limits the damage from mistakes while allowing you to benefit from successes. Third lesson is about thinking in 3 to 5 year time horizons, not 3 to 6 month time horizons. I'm buying these stocks because I think they'll be worth significantly more in 3 to 5 years. I'm not trying to trade them for quick profits. I'm not worried about where they'll be next quarter. This long-term thinking removes a lot of stress and allows you to ignore short-term volatility. Fourth lesson is about the power of buying when there's a margin of safety. All 3 of these stocks are trading well below what I estimate they're worth. The bank at 8.5 times earnings when it should trade at 12 to 14 times. The energy company at 6 times when it should trade at 8 to 10 times. The pharma company at 12 times when it should trade at 15 to 16 times. These margins of safety protect me if my estimates are somewhat wrong, even if the businesses don't perform quite as well as I expect. I should still make money because I'm buying at such cheap prices. Fifth lesson is about recognizing when all the pieces align. Business quality, attractive valuation, and catalysts for value realization. When all 3 are present, that's when you should bet big. That's when you should deploy significant capital. And that's exactly what I'm seeing now with these 3 stocks. The businesses are high quality, the valuations are attractive, and the catalysts are imminent. This combination is rare. It doesn't come along often. When it does, you need to act. Let me close with some specific action steps for how to implement this strategy. First, do your own research on these 3 sectors. Don't just take my word for it. Read about regional banks, study the banking business model, understand how they make money. Look at specific banks in the Southeast with strong balance sheets. Identify ones that meet the criteria I've described. Do the same with energy companies. Study the major integrated oil companies. Look at their production costs, reserve bases, and cash flow generation. Identify the ones with the best fundamentals trading at the cheapest valuations. And research pharmaceutical companies. Understand their drug portfolios and pipelines. Look for companies with diversified revenue streams and strong R&D capabilities, trading at reasonable multiples. Second, determine your allocation based on your situation. If you're younger with a long time horizon, you can be more aggressive. Maybe allocate 50% of your portfolio to these 3 stocks. If you're older or more conservative, maybe allocate 20 to 30%. The key is to have meaningful exposure so you benefit if the thesis plays out, but not so much that you're taking excessive risk. Third, buy systematically over the next few weeks. Don't try to time the exact bottom. Start buying in. Early December, maybe deploy half your intended capital in the first 2 weeks of December, then deploy the other half in late December, early January. This averages you in at good prices without the risk of buying everything at a temporary peak, fourth set price targets and time horizons. Decide in advance what you expect these stocks to be worth in 1 year and in 3 years. For the bank, maybe you target 12 times earnings in 1 year, which would be 40% upside. For energy, maybe you target 8 times earnings, which would be 35% upside. For pharma, maybe you target 15 times, which would be 25% upside. Having these targets helps you stay disciplined and avoid selling too early or holding too long. Fifth, be prepared for volatility. These stocks might decline before they rise. You might buy in December and see them down 10% in January. Don't panic. If the thesis is intact, if the fundamentals haven't changed, use weakness as an opportunity to buy more. Remember, you're investing for 3 to 5 years, not 3 to 5 months. Sixth, monitor the catalysts I've described. Watch for the OPEC meeting in early December. Watch for the Fed's December rate decision. Watch for fourth quarter earnings in January. Watch for the pharmaceutical company's drug approval decision. These events will tell you if the thesis is playing out as expected. If the catalysts materialize and the stocks aren't responding, that might be a sign to reassess. But if the catalysts materialize and the stocks do respond, that confirms the thesis. Seventh, have an exit strategy. Don't just buy and hope. Know under what conditions you'll sell. Maybe you sell if valuations reach your target multiples. Maybe you sell if the fundamentals deteriorate. Maybe you sell if better opportunities appear elsewhere. Having an exit strategy in advance prevents emotional decision-making later. Now, I want to address one final point that's crucial. Some people will read this and think I'm being hypocritical. They'll say, Warren, you always tell people to buy index funds and hold forever. Now, you're recommending specific stocks with specific timing. Isn't that contradictory? Let me be very clear about something. For most people, buying a low-cost S&P 500 index fund and holding it forever is the right strategy. Most people don't have the time, interest, or skill to analyze individual businesses. Most people don't have the emotional discipline to hold through volatility. Most people will do better by indexing than by trying to pick stocks. But there are situations where selecting individual stocks makes sense. If you have the time and interest to do deep research, if you understand businesses and can analyze financial statements, if you have the emotional discipline to buy when others are scared and hold through volatility, then selecting individual stocks during periods of opportunity can generate superior returns to indexing. That's what I'm describing here. This is not a strategy for everyone. This is a strategy for investors who are willing to do the work and who have the temperament for active investing. If that describes you, then these 3 stocks represent compelling opportunities right now. If it doesn't describe you, stick with index funds. There's no shame in that. Index funds are excellent investment vehicles for most people. My final thought is this. I'm 94 years old. I've been investing for over 80 years. I've seen countless market cycles, economic cycles, bull markets, bear markets, crashes, booms, panics, and manias. And through all of that experience, I've learned to recognize when special opportunities appear, opportunities where you can buy quality businesses at cheap prices with clear catalysts for value realization. We're in one of those moments right now. The 3 stocks I've described, a regional bank, an energy company, and a pharmaceutical company, they all meet my criteria. Quality businesses, attractive valuations, imminent catalysts. This combination doesn't come along often. And when it does, you need to act. That's why I'm moving into these stocks before January. That's why I'm deploying capital after sitting on cash for 2 years. And that's why you should consider doing the same if these opportunities align with your investment goals and risk tolerance. The window is now. The catalysts are coming in January and February. By March, these stocks could be trading significantly higher. The opportunity is to buy now while valuations are still attractive and position yourself for the next leg higher. Don't overthink it. Don't wait for perfect information. If you believe in the thesis, if you've done your research, if these investments make sense for your situation, act. Buy these stocks in December, hold them patiently, and let the catalysts play out over the next few quarters. That's what I'm doing. That's what's worked for 8 decades. And that's what I believe will work again this time.